Hello and welcome to the extensive weekend video, which is of course building on those predictions and how they unfolded as regards Jackson Hole. Great celebration for clients, well deserved, across the board. Things were magic. This is the chart that you can see, and I will be explaining what I told exactly clients, why, and those clues, how they played out. Yields, you can see, starting with these, that they had turned again south, because whenever Powell mentions restrictive monetary policy and his perception thereof, market got what it wanted. 2 rate cuts confirmed this year, and it's off to the races, and with very nice, very fine looking risk on sectoral view. When it comes to yields, this retreat is of course what is sending the US dollar down, which is the polar opposite of the ascent among inflation trades, inflation assets, and risk on posture in general. This weekly chart of the US dollar shows that fight nicely with those upper nodes, signifying rejection of the US dollar to go higher for quite some time. And this is the proper long-term perspective. Note where the US dollar had been trading 2011 and during the early phase of the Corona crisis. We are sitting right on that rising trend line, and this is very important for the fate of the world reserve currency. That was the proper long-term view. Here we go again with the hourly chart, Friday pre-market, that I had featured in Friday's video. Those patient ones had been rewarded because I dropped exactly the first clues which I did say to premium clients at the very end of that video, as a reward to those who had been patient enough to be watching. I hope you have enjoyed. Such was the commented chart that I shared with all clients at that moment. And here you can see the caption where I had been confirming the odds of several scenarios, and the preferred scenario was for the S&P 500 to flush below Wednesday's lows, and as Thursday was a day of indecision, that stop hunt did not happen by early Friday European hours, and that meant that my lesser preferred scenario, number 2, came into the fore, and that was the question of whether we see breakdown play out on Friday before Powell, or on Powell, or a breakdown that would bring a V-shaped bottom, or whether that consolidation would give way, whether that consolidation would be only a shallow one, giving way to stock market ascent. And that was exactly what had played out when it comes to all 3 indices. And no matter what happened on Friday, I was clear that Russell 2000 is and was, and for Monday that is a very clear sign too, is to outperform S&P 500. When it comes to the sectoral view, Thursday brought us a pretty risk-off day, and I was clear that I did not expect financial upswing to negate the tech being among the greatest laggards. Clearly very risk of day Thursday, de-risking, it was apparent when it comes to heavily shorted names and Max 7 stocks, which way the market is tipping to go right next. Here we go with Friday's sector view, which is pretty risk on. Is it a problem that tech had been lagging? Not exactly. I'm not looking and I was not looking for tech leadership in the S&P 500 upswing. Comparing index by index, S&P 500 grades spread higher, consolidating, building the high ground. You ask yourself, how likely is it for us to get a correction early in the week? Yeah. Nasdaq, the underperformer. Participating, not sufficiently, but that's not an issue. And the clear winner, Russell 2000. I was clear about small caps moving into the driver's seat, and after long months of underperformance, they had kind of got their acts together when it comes to the ratio of Russell 2000 to S&P 500, and now small caps are outperforming, which is a sign in itself, considering where rates are, and of course as well when it comes to several leading sectors that are supposed to and have been doing quite well, and clients know that during the week I had talked quite frequently biotech and as well home builders. Have a great weekend.